Hi everyone. Today's video, the topic is cost of capital. In this chapter, we'll discuss about the investor's point of view as well as firms' company's point of view. We'll discuss that how companies are calculating the cost, what they are going to be pay against their borrowings. As you know that all companies or corporation having their capital structure. In the capital structure, they are having debt capital, preferred stock, and common stock. Each stock or each security what companies are issuing to their investors, they are paying return to them. This return is a expenses as a company's point of view. So that's why it is known as cost against the capital. Let's go and start. Cost of capital. Topics are going to be covered under this video are introduction, definition, the cost of capital, cost of debt capital, cost of preferred stock, cost of common stock, and under the common stock we'll discuss about the internal common equity and external common equity. Let's start with the introduction. The cost of capital is the minimum rate of return that a company requires from its investment in order to ensure that the market value of its shares either increase or remain at the same level. In other words, cost of capital refers to the opportunity cost of making a specific investment. It is the rate of return that could have been earned by putting the same money into the different investment with equal risk. Thus, the cost of capital is the rate of required return to pursue the investors to make a given investment. Definition of cost of capital. The rate that must be earned in order to satisfy the required rate of return. This is the number one. When we are defining the cost of capital, the second thing is there the rate of return on investment at which the price of company's common stock will remain unchanged. Means there is no change in company's return against the common stock, means owner's equity. Let's go back for revision. As we know that when we are understanding any wealth of organization, we have to be understand about the balance sheets. So let's snapshots of balance sheet. Balance sheet, you know that we have a two column, assets and liabilities. In assets column, mostly companies are having current assets and current liabilities in a liability column, as well as fixed assets, and in liabilities column they are having long-term debt, preferred stock, and common stock. As we know that current assets and fixed assets means total assets is investment decision by any corporation. If we are going for same balance sheet, and we have to be identify the financing decision. So just repetition of balance sheet, assets and liability as well, current assets and current liability, as well as fixed assets and long-term debt, preferred stock, common stock. Now, this total liability is reflecting the financing decision of the organization. You remember that we already discussed that all corporation, all companies are having investment decision, financing decision, and dividend decision. So here we discuss about the investing decision and financing decision. Again, we will go to identify the capital structure because it is playing very important role when we are analyzing the cost of capital. So again, the same balance sheet here, you will go one by one, common assets and liabilities, current assets and current liabilities, as well as fixed assets in assets column and long-term debt, preferred stock, and common stock. So here when we are going to be explain that what is the capital structure, it means where companies are investing their capital, we define long-term debt, preferred stock, common stock. From here our chapter started of cost of capital. It means we have to be understand that what cost we are going to be bear, our investors are going to be bear when they are investing in this type of capital structure. So continue, or let's understand the rate of return first. As I told you that here we are having two perspectives. So I am going to be discuss in our video both perspective. So first, if we'll go A look of investors' perspective. It means what investors are getting when they are investing any amount in any corporation. So the rate of return on a security is a benefit of investing. It means whenever you are planning to invest, you are getting some return against your investment. So this is your benefit what you are getting. The same when we are discussing about the company's perspective, it means what the financial manager of any corporation are thinking before looking for investments or financing decision. The rate of return is a cost. It means they are expending the money when they are getting money from any investors. That's why it is known as cost. Raising funds that are needed to operate the firms or operate the company or corporation. So financial manager is targeting that how we are collecting the fund from the investors, and against the collection of fund what money we are returning to them or additional money returning to them. It is reflecting that cost of capital. This is a firm's or company's prospects. In other words, the cost of raising fund is the company's cost of capital. So now we understand what is the cost of capital. Mostly it is reflecting to the company's investment and company's cost against the investor's investment. Hope you understand. We'll continue in the same way. Does the investor's required rate of return differ than the company's cost of capital? As I discussed in this video, two prospects, investors as well as company or firms. So now we get to know that both are having same or different way to understand the cost of capital. When we are asking that different, our answer is yes. Investors' required rate of return is not the same as the company's cost of capital because of two reasons are there. Reason number one, taxes. Interest payment on the debt are tax deductible to the company. As you know that when we are paying interest to the investors, we are paying before paying tax. Our companies are not paying tax in a company's perspective, and it is going to the investors. And when companies are going to be paid preferred stock or common stock, they are going to be paid after tax. Hope you remember when I discussed in a previous video about the income statement for the dividend policy. If you didn't understand, you can go back and try to understand when we are discussing understanding of financial statement. There in that video, I explain about the income statement. As you know that income statement is a revenue minus cost of goods sold. It is mentioning your gross profit, then you have to be reduce the operating expenses including depreciation, then you will get EBIT, earning before interest and tax. We will continue from the EBIT in future in this video as well. After EBIT, you know that earning before interest and tax, first corporations are paying interest to the debt holders or bond holders. So once after we are paying that debt holders, we are getting earning after tax. It is reflecting EAT, and then we are going to be pay taxes. Once we are paying taxes, the balance amount is going to be paid to the preferred stockholders and then common stockholders. I will explain in the same video. Let's with me. Now we'll discuss about the second reason. Flotation cost. Companies incur expenses or spending the money when issuing securities. It means that is a reduce the income. Like suppose if company need $1,000 from any investors, or companies are spending $50 during the marketing or paying brokerage cost or paying the agencies cost or paying to the banks when they are offering any share or any debt capital in the market. So actually companies are not getting $1,000 against their sale because 50 they are already spending. So actually they are getting only 950. 1000 minus 50 is become 950. So it means flotation cost is also play an important role to understanding the cost of capital as well as required rate of return. Hope you understand this both point of view. So this is the two reasons we can say that because of these reasons, investors and companies rate of return is not similar. How do the company raise their capital? As we say that company have their own structure. Our companies are getting capital through that structure. Let's explain again. Corporation may raise funds to finance their operations or new investment by raising capital through bonds investment, preferred stocks, and common stocks. So there are only three capital resources are available for the company: bond, preferred stock, and common stock. Company can issue any one in the market as per their requirement or as per to reduce their cost and increase the profit in future. Each of these offer a rate of return to their investors. It means whenever you will sell this, company will sell this any one of these three securities, company must be pay some return to their investment. Investors are looking the better return, but wherever it is available, they are investing in that. Hope you understand. Let's come with me and we'll continue to understand about the cost of capital in this video. This return is a cost of the firms. Whatever they are returning, whatever extra money they are paying to their investor, this is the cost, or this is the expenses what the company or corporations are going to be bear. Cost of capital actually refer to the weighted cost of capital. Why we are telling that weighted cost of capital? Because it is mix of all three, either bond, preferred stock, and common stock. Even though not only on three, it should be depend upon the number of securities issued in the market or number of portion invested in the securities. I will explain through the example. Let's continue, or let's analyze the cost of capital of individual. First we'll go one by one. First we'll go for the cost of debt capital, or you can say that cost of bond. For the issuing company, the cost of debt is the rate of return required by investors are adjusted for flotation cost, any cost associated with issuing new bonds or new debts in the market, and adjusted for taxes. Let's go for the example for a better understanding. As you know that always my videos are bringing examples or cases to define the logic of the chapter. So let us see, we'll discuss about the example, but we will focus about the tax effect because tax is affecting the debt capital. So keep in our mind, we are going to be focused here on tax. Suppose a firm pay $50,000 in interest expenses to the debt holder. Suppose we are going to be analyze the company. We know that, as I told you, that income statement after getting profit means earning before interest and tax. It is known as EBIT. When we are reducing interest expenses, if suppose companies are stock-based company, they will not give to any interest to the stockholders because stock interest is reflecting only bondholders. So if bondholder company is there or bond-based company is there, as we explained that here we are paying 50,000 to bondholders. So now after paying interest, if with the stock company have same EBIT and EBT, earning before tax, only I remove from there because interest paid. But we have company have a debt holders, company's EBIT is our earning before tax is 350,000. After tax, company is paying taxes. Here we are assuming suppose tax is 34%. In both places we have to be pay taxes, either with the stock or with the debt. With stock, when you will calculate 30% against 400,000, you will get 136,000. Same as when you will calculate 34% against 350,000, your tax will become 119,000. And the difference will become EAT. It is known as earning after tax. So now earning after tax with stock is 264,000 and with debt is 231,000. So it means earning those companies are issuing stock, their earning is better after tax instead of debt capital, but it is not going to be a solution. So once we are going to be continuous, suppose if company will not pay interest, then company must be paid to the shareholders return or shareholders cost. Suppose here we are assuming that the same either companies are paying to the debt holders or companies are going to be paid to the stockholders. So we assume that 50,000 companies are going to be paid to the stockholders as a dividend. Let's examine again the same situations. As we know that company have EBIT 400,000, interest expenses only for the debt we are paying 50,000, EBIT 400,000, 350, tax we already calculated 136,000 and 119,000 in a previous slide, and we get to know that before also earning after tax is 264,000 with the stock and with debt 231,000. But now we are going to be paid dividends, as we know that dividend is paying against stock, not against debt. So it means we will pay 50,000 to the debt holders, sorry, stockholders. There is zero for the debt because debt is not eligible to get the dividends. So what is the retained earning? What the money companies are going to be reinvest with them if both are equal, either the debt holder or the stockholders. Now we get to know that stockholders, when we are offering investment against the stock, company is able to reinvest only 214,000 in the organization, in the corporation, in the firm. But if companies are issuing debt, company have 231,000 return as a retained earning. So it means we can analyze the situation. In this situation, we can say that if companies are paying either 50,000 to the stockholders and 50,000 to the debt holder with the same tax percentage, in this condition, debt capital is showing that we are getting more return instead of the stock issuing. So that's why mostly companies are issuing that debt capital is a cheapest source of finance, because whether companies paying equally because of tax benefits, companies are getting more return or companies are expecting more money to reinvestment with them. I hope so you understand. If not, don't forget to write your comments in my video comment box and I will give you a proper understanding. If you need, I will develop another cases and definitely discuss with you. Be with me always. You will get a lot of learnings through my videos. So cost of debt capital. Finding the cost of debt stock is similar to finding the rate of return, except that we have to consider the flotation cost associated with issuing the debt stock. It means when we are comparing about the required rate of return or cost of capital, it is similar calculation. Just only the difference is coming flotation cost. When we are calculating required rate of return, we are not considering the flotation cost, means issuing cost. But here we will consider the flotation cost as well. Let's recall. As an investor's point of view, we remember that when we are calculating cost of debt capital, we are paying interest paid divided by prices, means the money what we are receiving against the issue of stock. We can say that face value or we can say the par value. In previous slides when we discuss about this or when we discuss about the time value of money, we use the word, this is interest paid, we use with the C, and the amount what we receive we say that P0. So here we can say also in other way, we will show the short form, we can say that interest is reflecting INT and price is showing that P0, that means value of the stock. Where the explanation is there, KD is the cost of debt capital before tax. Keep in your mind here, when we are returning the cost to the debt holders, it is paying before tax to the government. It means companies are returning the money to the investors before paying corporate tax. So that's why it is known as before tax cost of capital. INT is reflecting interest paid on debt capital. P0 is showing that price at which debt capital issued in the market. From the firm's point of view, this is investor point of view, the firm point of view. A small change will become, we'll say that KD is equal to INT upon NP0. It means here we just added only N. What's the meaning of N? NP0 means net price. Here we are using price or net price. What's the net price? Net price is reflecting the total price minus flotation cost. Because when the firm will be get money, firm will not give the same what company issued. Like as I given the example before to you, if companies are selling their one debt stock for 1,000 and they are spending $50 as a flotation cost, So company's net price, what company is going to be received, it is 950 only, 1000 minus 50. But investors are paying 1000, so their price is only 1000. We will understand through an example. Let's go for the example. ABC Corporation issue a 120 years bond paying a market rate of 10%. It means the interest or the cost is 10%. Coupon are semi-annually, it means they are paying 2 times in a year. The bond will sell the par since pays the market rate, but the flotation cost amount $5 per bond. What is the pre-tax and after-tax cost of ABC Corporation? Let's go for the solution. As an investor's point of view, your return against the investment is $10. Let's analyze the firm's point of view here, because we know that every year either 5% in 2 times you will get 10% return. But what the firm is going to be get annually, here we will calculate annually for the firm for better understanding. Semi-annually we already showed when we are discussing about the time value of money. For more understanding or deep understanding, you can go to my video. I have 6 videos in a series with time value of money. You can get a lot of informations related to returns. So here NP0 is equal to 100 minus 5 is equal to 95. Let's put this value in the formula. KD is equal to INT divided by NP0, and INT means 10%. So we have interest amount 10% against $100. You will get $10 divided by net price. What companies are receiving, it is 95 instead of 100, because 5 is they are spending as a flotation cost. So it means the cost what the companies are going to be bear, that is 0.1061, or in other word we can say that 10.61%. So look, investors cost is 10%, but actually companies bearing more than that what the investors they are going to be offer to the investor. It is 10.61. This is because of flotation cost. So that's why we need to calculate, or we will get to know that what companies are getting. So if company's internal required rate of return is more than 10.61, company can survive or company can enjoy the profit. Otherwise, company will become in a risky situation. So this is why we are going to be analyze the cost of. Hope you are understanding till now. We'll continue. For calculating after tax cost of capital, we will use the following formula, because as you know that we have other calculation in future. When we are calculating preferred stock or common stock, it is based after tax. So we should convert, when we are going for weighted average, we should convert the debt capital is also after tax. So that's why we needed after tax formula calculating after tax debt capital. Here we are using KDT is equal to KD in bracket 1 minus T, where KDT is equal to cost of debt capital after tax. KD is equal to cost of debt capital before tax. T is a tax rate. And now if we want to know that what is KDT, if we will use the previous example, as you know that KD came 0.1061, or you can say that 10.61%. We already calculated in a previous slide. And tax rate also we assume 34%. So same here, we will continue 34%. Now what is the KDT? We will put the value of KD as we calculated 0.1061 and multiply by 1 minus T. Tax rate is 34%. So it is coming actually 0.07, or you can say around 7%. This is just a round up value. Once you will calculate, you will get approx value. So what the meaning of 10.61% or 7%? It means a 10% bond cost for the firm is only 7% with flotation cost, since the interest is tax deductible. So company will be going to be get only 7% when companies are offering 10% to the investors. In the beginning of the question, we said that companies are offering 10% bond in the market, so it is 10%. So now after tax, the value is 7% only. Hope you understand. Let's continue with the preferred stock. Finding the cost of preferred stock is similar to finding the rate of return, except that we have to be considered the flotation cost associated with issuing preferred stock. Similar as debt stock, as you know that when we before discussed in a time value of money about the cost of means required rate of return on debt holders or required rate of return on preferred stock, we already calculated. So this is not new for you, and if you are not having a much understanding, again my suggestion, go and watch my videos. You will get a more broad sense or broad view against these calculations. Let's again recall, as an investor's point of view, we already discussed required rate of return. Here we are using cost of capital. Cost of capital we are showing with KPT is equal to, because KPT we are using after tax, so T is already included here. The formula is dividend upon price. In short, we can say that D upon P0. But if we are going for firm's point of view, the small changes will become P0 will be converted NP0. So the same we can use net price, or D is divided by NP0. NP0 is same price minus flotation cost, as we already discussed in the dividend. Let's go for the example for understanding. If ABC Corporation issue preferred stock, it will pay a dividend of $8 per year and should be valued at $75 per share. It means suppose the value of share is 75 in the market and companies are paying $8 as a dividend every year. If the flotation cost is $1 per share, what is the cost of preferred stock? Let's go to understand ABC's preferred stock cost. As an investor's point of view, as you know that KPT is equal to dividend divided by price, or you can say that 8, because the dividend we are paying $8 out of 75. So we can say that 0.1067 or 10.67% is the cost of preferred stock after tax. If we are going for firm's point of view or company's point of view, same formula we will change with the net price only. What is the net price here? It is 75 minus 1. So 8 divided by 74 and you will get 0.1081. It means 10.81%. How to calculate NP0? 75 minus 1. The price of stock in market 75 and flotation cost what companies are going to be spent during the issue is $1. 74 is actual money what the company will receive. So look, the company's cost is different than the investor's cost, as we discussed in before. Till now, hope you are understanding. The things are going in a proper way and you are learning a lot during these things. We'll continue. So in continuation, now we'll discuss about the cost of common stock. There are two sources of common equity. Common equity, as you know that we already discussed many times in our previous videos, this is a owner's investment in the corporation. So once we are talking about the owner's investment, so we have a two type of investments. So one is internal common equity. It means it is based on the retained earning. Retained earning means the owner's money what company earn and not paying to the owner, reinvesting in the company at the same time. So it is reflecting the retained earning. The second thing is their external common equity. It means if company need more fund or more money for new projects or new products, companies are offering new shares in a market to increase their stockholders. So this is a new common equities. So there are two ways to increase or raise funds in the corporation. Let's start with the cost of internal equity. When we will recall in previous, as we said that when we calculate the required rate of return, same we are going to be discussed here in a cost of capital. So once we will recall, we will get to know that we discuss dividend growth model, and this model we will discuss in a dividend policy chapter as well. You can go to the dividend policy, you will get all information over there. My videos are available. Whenever you have any doubt, it is related or cross-referencing, you must be go with the other video for a better understanding. So the formula for calculating dividend with the growth model is KC. C is showing that common stock. So KC is equal to D1 divided by P0. Dividend means after 1 year what we are going to be paid, it is a D1. It is totally explained in the previous videos. P0 again the price at 0 level means at the beginning level what we started plus growth, whatever the growth rate is there. Full calculations are available in time value of money when we'll show about the internal equity. Full calculations are there. I will not go here in a deep calculation, so you can go there. And in my next videos, I'm going to be present some case studies. In that case study, definitely I will solve these type of problems for your understanding. So wait and watch. You will get new videos that will be help you a lot to understand about the cost of capital through the example or through the cases basis. From the firm's point of view, if you are going to be calculate, the only change will become as previously P0 will be converted in NP0, and now you are very much aware because two times we presented with the debt and the preferred stock. Net present value or net price. We can say that whatever net price, it will be reduced only flotation cost. As you know, net price is equal to price minus flotation cost. Here we have another model. This is a capital assets pricing model. It is very famous model, CAPM model. Again, I am telling to you, we already showed many examples. We solved many problems during the dividend chapter. Just go to the dividend chapter. You will get a lot of information through it, how to calculate. I will just bring the formula here, how to calculate cost of capital. It is cost of common equity is equal to risk-free return, that is KRF. It means whatever cost is there against the risk-free return plus the beta risk, and in bracket market return minus risk-free return, or we can say the risk premium. Capital assets pricing model totally covered in the required rate of return video. Just please go and visit my video required rate of return. You will get full information and so many examples over there. So this is the calculation of internal equity as well. Now we have to be understand about the cost of capital, weighted average cost of capital. Weighted average cost of capital means once we calculated the cost of all three debts, debt holders, stockholders means preferred stock as well as common stock, then we will calculate the weighted base. So let us understand capital. As you know that we have a three understanding about the capital: the source of capital, the cost of capital, and the structure capital or capital structure. Like suppose in any company we have a debt capital, the cost of debt capital is suppose 6% and 20% of investment is against debt. Same as we have a preferred stockholders or preferred capital. Suppose the cost of preferred capital is 10% and 10% investment is against preferred stocks. Common stockholders, suppose the return is 16% and 70% of money we got or we collected in the corporation through the common stock. So it means now we are having full structure, or 100% structure is there, 70 plus 10 plus 20, or you can say the 20 plus 10 plus 70. So it means this is reflecting your capital structure and investment. On the basis of this, once we calculated the cost, how we'll get the cost of capital? Same the formula what I explained you before, either debt capital or preferred capital or common equity. You can calculate accordingly the cost what we are bearing. But keep in your mind the debt capital is always after tax here. Once we will put the value of cost of capital, because preferred stock and common stock is already after tax. So debt capital should be after tax. So we will calculate the formula. First we will calculate cost of debt capital. It is coming before capital. Then we will put the formula how to calculate after tax. It is there in the same video. You can go through it again if you have any confusion. We'll put the values here. How to calculate weighted average. Weighted average is a simple calculation when we are doing multiplying the cost with the structure. So 20% against 6%, 10 against 10%, 70 against 16. So once you will multiply, you will get the overall percentage, that is 13.4%. So weighted average cost of capital means the overall cost what companies are bearing about all three investment, it is weighted average cost. So these are the basic information under this video. Just the introductory part I brought here. In further videos, definitely you will go for a deep understanding about the cost of capital. Be with me. Always I'm trying to help you all. So please continue. You will watch my videos, but don't forget to like and subscribe. It will be encourage my efforts. Thank you very much for watching and getting a knowledge.